Hi, everyone, and welcome to another edition of our great educational series. Today, we are joined by Kristen Kuliga with Justly. It is going to be covering the ins and outs and the basics of Reg A, Reg Ds, and crowdfunding. So if you're interested in investing in basically private placements in several different arenas, essentially securities that are not on a traded securities market, this is the woman to talk to and get some more information, especially with regard to certain types of market segments, which I'll let them get into. I had interviewed on our podcast, the Alternative Investing Advantage podcast, one of their other executives, Paul, and it's a great look into kind of the alternative side of the metrics to use for investing and looking at the economic, social impact that companies have with doing impact investing. So it's going to be a really great presentation today. We're excited to have her on today. Thanks for being with us today, Kristen.
Thank you very much. Appreciate it.
All right. So just to get started a little bit, I'll introduce myself and then I'll introduce Kristen once we have her portion of it. My name's Alex Perny. I have been with Advanta for 10 years tomorrow. So I've been doing this for a little while now with regard to private investments and utilizing qualified retirement funds to invest in alternative assets that aren't on a traded securities market. So what I want people to understand past just the great information you're going to get from Kristen today is that you can use qualified IRA funds for pretty much any type of investment, so long as that we can accurately record keep and hold that type of investment for you. And before I do kind of get much past this, if you do have any questions today, make sure you drop those in the chat box. Everyone's audio has been muted, but I will certainly pose those to Kristen at certain times throughout it, or if you have a question for me, feel free to ask. Keep in mind that asking questions is a great way to get more engagement and also help to get better information to the people on the call, so please do make sure that you ask those questions. Also, if you'd like a copy of today's slides, you can grab them right from the handout section of the webinar you've logged into, or we'll be happy to email them to you afterwards as well. So if you'd like those, feel free to reach out and grab them. A quick disclaimer before we do get started: Advanta IRA and our employees do not provide investment or legal advice, nor do we endorse or promote any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Now that we've made our attorneys happy, a little bit about Advanta. We have almost 20 years in the investment industry, specifically focused on self-directed IRAs and in alternative investments. We didn't start out as a brokerage house that dipped their toe into the alternative investment space. We started it as an alternative investment company, and we are maintaining that through our life cycle. So that's really all we focused on for the past 20 years, is doing these types of alternative investments through qualified retirement plans. We hold currently almost $2 billion worth of assets under administration for our clients, which is something that we're very proud of. We just crossed over that threshold earlier this year with our market value updates. So we're very proud of that fact, that we've grown from kind of a couple people doing this back in 2004 to where we're at now with almost 7,000 clients doing these types of alternative investments. If you're interested in doing this, keep in mind that although this may be kind of a different way of thinking about investing your retirement funds, you're not necessarily giving up any of the traditional protections that you would get from any type of banking institution. All cash deposits here are fully FDIC insured up to the applicable limits, and we also maintain errors and omissions, surety bonds, and additional insurances against any type of actions that you might traditionally see at a typical brokerage house. But what we're most proud of, besides obviously the value of the assets that our clients hold, is the real personal touch that we offer to all of our Advanta clients. Every single client here gets a dedicated account manager. So if you're interested in doing this type of investing, and maybe it's your first foray into it, or you have a very high administrative workload asset that you need, you don't have to pay extra. You don't have to have a certain amount of assets invested with us. Every single person gets that dedicated concierge level service. So if you want to do this, keep in mind that we are here to help and can certainly guide you right through that. Past just the service that we offer, we're also really proud of the education that we put on. We hold at least 2, if not 3 events per week, 4 if you count the podcast that I host here at Advanta. And all of our education is for the very low price of free. If you're here today, this is what we always charge for our education. We want to make sure that the investors out there are informed investors making informed decisions, so that way they can go the best route for themselves possible. We hold these seminars and webinars, and also we have a networking event every other Friday, which I'll get into here in a moment. But if you'd ever like to reach out to us, feel free. Just go onto our website. Under the resources tab, you can find all of our events listed. You can sign up for them. There's no commitment. There's no obligation. If you miss an event, or maybe you like to go back and kind of look at what was covered a little bit more in depth, we also maintain a video library on YouTube where you can view any and all of our recordings, with the exception of our Pitch, Promote, and Prosper networking event, which we do not record. And then also, if you're more of someone that just likes to read and consume your information that way, we do host a blog as well, all of which can be found on our website. The Pitch, Promote, and Prosper that I mentioned, a lot of people are coming to us looking for investments and looking to see how they can get their money deployed. While here at Advanta, again, per the disclaimer I read, we don't promote, endorse, or sell any investment products. But if you'd like to be able to get in front of people that maybe do have deals, or you have a deal that you'd like to promote, or you'd like to raise some capital, we do have an avenue for that where you can get on and pitch what you have going on. Essentially, we host it with two of our employees. Typically, it's myself and my colleague Larissa here in Florida, or some other combination of our education and sales team that host it. Everyone's given about 60 to 90 seconds to pitch what they have going on, and we also host a open discussion. So it's a really great event. We have people from all over the world. We were having people from Southeast Asia tune on to it for a while, and it's a really cool event. We're really proud of it. Typically, we have anywhere between 30 to 80 investors on that call every other Friday. So if you'd like to join, go to advantaira.com/events, and you can sign up right there. Again, free, not recorded, every other Friday. Now, what is a self-directed IRA? Most people that attend these are relatively familiar with it, but if you're really kind of just delving into it, you may have heard the term self-directed IRA thrown around by other investment companies, and you think, well, brokerage house A says I can do a self-directed IRA with them, but when I ask them about buying real estate, or from the perspective of our guests today, buying maybe a private security or investing in a startup company, they told me no, and they gave me all this red tape about how it would be taxable and everything else like that. Really what it boils down to is that IRA custodian's willingness to hold a certain type of asset. The IRS really does not have a micromanaged approach to how they allow for certain types of investments. They basically say, hey, here's certain people you can't invest with. You can't buy something to or from yourself. You can't directly invest with your nuclear family, and you can't buy life insurance or a collectible. Past that, it is really kind of the discretion of the custodian of whether or not they will hold a particular type of asset, which is where we come in. Truly self-directed IRA administration and custody for these types of assets. So if you want to buy all sorts of different types of alternatives, we can certainly help you out with that, which helps you create real diversity. That's one of the big things that I like to illustrate to clients, is that they'll say, oh, well, I'm diversified insofar as that, let's say I own some energy sector stocks, and I own some tech stocks, and I own X, Y, and Z, but they're all stocks. It's, you're diversified in your maybe the market segment you're invested in, but not the actual type of asset. If I ask you what type of asset you held, you say, oh, well, I own a bunch of, publicly traded securities. Whereas with a custodian like Advanta, you get to say, oh, well, I'm diversified. I with my retirement plan, I own some securities. I actually own a piece of real estate with my IRA. I own private securities in a startup company. So you can actually truly diversify and really take control of your investing trajectory and your different risk tolerances by utilizing a service like ours. Now, again, since the assets are not publicly traded, they don't impact the returns as much. Alternative investments carry their own inherent risk and can impact an investor's returns. The offering document should be consulted for details, especially in the context of what we're going to cover with private securities. You always need to make sure you're doing your due diligence. Just because a certain platform offers you diversity without education and research is just as risky as throwing a dart at a wall. You need to make sure you do your research. You need to make sure you do all of your due diligence to make sure that you are protecting yourself and any potential future returns that you're looking to make with an IRA. Now, IRAs are a great source of capital as well. Why are self-directed IRAs a good source of capital? So for people on the call that maybe are looking to raise capital from a particular subset of people, the IRAs are a really great way to do it because you can easily attain repeat investors. So you can solicit existing investors to reinvest into your deal that you're putting together simply by using their IRA account. So essentially you can wring more money from the same individuals as you otherwise might be able to if you're just using personal taxable money or things outside of a qualified IRA account. Most people are not expecting to use their IRA funds soon. So if you're putting together something that, let's say, has a much longer time horizon, people typically are a little bit more susceptible to saying, hey, I wasn't planning on using my IRA funds in the next 5, 10 years anyway. I don't mind locking it up with that. And also you can potentially get a little bit better returns with an IRA if you're comparing deal to deal, because you're not having to pay any taxes on what you're returning back to an individual. So the individual client, if they're using their IRA, can simply say, hey, I'm going to take this interest or this return that I make, compound it right into the next deal without having to worry about particular tax filing or escrowing, anything out like that. And essentially, a lot of people with IRAs are inherently very conservative as well. So it allows you to potentially offer, potential higher returns to people, because most CDs well, actually are less now, sitting in 1 to 2% money markets or CDs. So the potential for significantly higher amounts of returns are a very attractive aspect as well. And again, you don't need any outside approval to use your IRA for a particular type of investment. The IRA owner in a self-directed IRA makes all of the investment choices. They do all of their own due diligence. We at Advanta don't maintain an invested position as a company in anything that our clients do. So we have zero conflict of interest. If you want to invest in Fund A, but we also have a client that's investing in a directly competing particular asset class, it's not going to be a conflict for us to do that, because we have no inherent direct investment with our corporate fund. So definitely another good thing to keep in mind when looking at doing self-direction. Now, when I talk about self-direction, it's not just traditional and Roth IRAs. I want people to take away from this that you have a large variety of different types of plans that you can use for this. Whether you're looking to use more of your capital or whether you're looking to raise more capital, there are a lot of there are a lot of different types of accounts that you can use for this. Traditional IRAs, Roth IRAs, simple IRAs, SEP IRAs, individual 401k plans. People can even invest in private securities with a health savings account or an education savings account. The biggest thing that I like to get across to people is that, and I don't know where this particular train of thought came from, is that a lot of people are under the impression of saying, oh, well, I don't have a Roth IRA, I can't do that type of investment. Well, that's really not the case. Roth IRAs are great. Who doesn't like not paying taxes? I would wager that everyone on this call would probably be raising their hand if I asked, who likes paying taxes and would you rather not? Most people would probably rather not pay them. So Roth IRAs are a great tool, but not everyone necessarily fits into the mold of someone that's going to greatly benefit from always having a after-tax type of an account. Many people need tax deductions. So things like pre-tax traditional IRAs, SEP IRAs, simple IRAs, and 401k plans can be a great tool to use. You don't necessarily have to fit yourself into one box to do self-direction or make a good investment choice. You can utilize any of these different types of plans that are up here. And the biggest thing I can tell people is that if you're a little bit confused or on the fence about, maybe which way do I go or what are the benefits from one to another, give me a call. Like I said at the very beginning of this, I've been doing this for just about 10 years now. I've seen the way that legislation has gone through a few different administrations and what kind of stuff to look for, which directions that things go, and how this can potentially impact you down the road. So I'm more than happy to share my knowledge with you when it comes to that and trying to help you make the most informed decision about which type of an account or tax qualification of an account that might be best suited for you. Obviously, again, we can't provide tax or legal advice, but I can at least get you pointed in the right direction and get you the correct resources to figure out, hey, which one of these kind of things is going to be the best fit for me. Now, I mentioned there's a lot of different alternatives, assets that you can invest in with self-directed IRAs. The main core of what we started out doing was real estate for clients. I would say probably about 60% of our assets under administration are real estate related, whether that's debt or whether that's people that bought property directly. So again, what I really like to illustrate with this, even though that we're not necessarily going to be covering real estate per se in the actual meat of this with our presenter, with our guest, sorry, is that there's really not one thing that's going to fit everyone. If you have a deal or there's some particular thing that you'd like to do, it's not that we're going to impose and say, hey, if you want to invest in real estate, it has to be a single family home, or hey, I want to invest in this offering. Oh, well, it's Reg D, not Reg A. Hey, that's not for us to say. It's just for us to make sure that everything is properly titled, properly documented, and then record kept for your IRA. So whether it's a crowdfunding platform, whether it's a Reg D offering and a limited partnership, whether it's some type of direct security offering, and let's say like a Series A offering of a capital raise for a private placement, we can do all those different kinds of things. It's not just one size fits all. The best thing to understand is that when it comes to doing this type of investing is to ask, give us a call. It can be everything from multifamily syndication to crowdfunding projects, private LLCs or small multi-member LLCs. Precious metals are again a big thing right now. Cryptocurrency is definitely something we do, but on my podcast today, the Alternative Investing Advantage, I got into a lot of what some of the current issues are with how liquidity works in the exchange markets for cryptocurrency. So if you want to learn more about cryptocurrency, although it was a slightly more critical review of some of the things going on right now, I'd encourage you to check that out. That one publishes tomorrow on wherever you find your podcast. Again, that's the Alternative Investing Advantage podcast by me here at Advanta. And again, why do people choose to self-direct? A big one is a new source of capital. A lot of people just don't realize that, hey, my IRA can do more than just buy a couple mutual funds or have a money market or a CD, that you really truly do have a lot of options here with regard to exactly how you invest your funds. It's not just, one company saying, oh, well, hey, if you'd like to buy these stocks, great. If you want to buy this mutual fund or ETF, even better. You have the ability to do it. You just need the right company to step in and take care of that type of administrative work for you. And if you're tired of the stock market, I know a lot of people are tired of the stock market over the past couple weeks or month, just from, let's just call it the rather garrulous situations that some of these people have been put into. A lot of people are getting really hammered out there on the stock exchange. But if you want to try to stymie some of that, there are a lot of alternatives out there, whether it be real estate, whether it be debt instruments, private placements. There are a lot of options out there for you that can help shield you from the rather volatile swings that you can see in a publicly traded securities market. And again, the tax benefits of doing this stuff are fantastic. Everything that's paid back to one of these types of accounts, any gains you make, any type of disbursements, let's say you're invested in a limited partnership, your return on capital, everything is paid back into the IRA without any taxes. You don't have to worry about a separate filing or any type of other weird specific things to do. It's just a cash on cash return, and you don't have to worry about factoring that into your personal tax return either. So again, new sources of capital, just being fatigued by the stock market, which I think a lot of people right now are. It takes part-time looking but full-time bandwidth to just understand that it is a wild ride out there for people invested in the stock market. And then again, tax benefits are fantastic as well. Okay, I just want to double check the questions because I think we're getting up to the handoff. Okay, great. Today we have Kristen with Justly. Kristen is a registered director of investments at Justly, a registered broker dealer that helps to promote ESG profiles. She has 25 plus years in the sports marketing and management industry. She was the first woman to negotiate an NFL quarterback's contract, which is awesome. Member of the Massachusetts Bar and holds FINRA Series 82 and 63 licenses. If you'd like to get in touch with Kristen, her email is right there, and I'd encourage you to reach out with any specific questions you have for her. With that said, I'm going to go ahead and hand it over. Kristen, I will monitor the questions as they come in, but if you want to go ahead and take mouse and keyboard control, go for it, and I'll just kind of chime in a little bit and pepper you with any questions. Again, please ask questions if you have them, and I will post them over to her. With that said, thanks for being with us.
Great. Thank you so much, Alex. I really appreciate it. And I'm excited to let you know a little bit more about Justly and what we do over there, and why I joined just recently and moved my broker-dealer licenses over to Justly. So what I'm here to do is talk a little bit about, what is Reg D, what is Reg CF, what is a Reg A, and so I want to try to keep it sort of really top line and simple for everyone. Reg D is an opportunity for companies to raise capital. They're privately held companies, so they're not in the stock market, they're not public, and it allows for companies to raise money through private investors. So Reg 506B offering is typically where the issuer, meaning the company that's raising the money, or the broker dealer that's helping the issuer raise money, goes to known investors, accredited investors that they know. Reg 506B C offerings can basically be published on the internet and can be to anyone, except that they do need to all be accredited investors. And I'll get into what does that mean? What is an accredited investor? And what does that mean for you on this webinar? Are you an accredited investor in such case that you could invest in some of these deals under the Reg D 506B or 506C? Reg CF is crowdfunding platform. And so anyone, you don't have to be an accredited investor, can invest under the crowdfunding platform. Reg A Tier 1 allows for a company to do a public offering where they don't have to register under the SEC. And Reg A Tier 1, they can raise up to $20 million, and under Tier 2, they can raise up to $75 million. So I'm going to try to move along here. What are the risks about investing into private placements? There's a lack of immediate liquidity, meaning that unlike a stock that you may own, a publicly traded stock, or even a real estate, that you may own, you can't just sell it typically on the public market. So you can't immediately get your money back or get a profit from it. And so typically it's a longer period of time that you own. The earlier stage companies, you probably heard about seed stage or Series A rounds, meaning that's the earlier stage of money that companies raise. Those are usually a longer period of time before you're going to see a liquidity event. Either they're going to sell to another company, or they're going to have a public exit where the stock will then be traded publicly, where you then would be able to sell your stock for money, for cash. And so that's one of the risks. The other risk is that it is speculative. It's not publicly traded, so there's not as much stringency of really understanding, what is going to be the future, or what they need to put forward to the public. And then you have to be of the assumption, I guess you could say, that you could potentially lose all of your investment. Unlike a publicly traded stock that may go up or down, or an asset like real estate that may go up or down, with privately held Reg D offerings, or Reg CF or A, you could potentially lose your entire investment. And so all of those things really need to be put into consideration before you look to put how much you'd like to put at risk and in what types of deals you feel comfortable doing. And so you really have to evaluate all of those before you make a decision in that.
That's a great point you bring up, Kristen. Can we go back to the last slide real quick? I have a couple points that I just want to kind of pepper you with on that, if you don't mind.
Sure.
Sure. So I think just to make sure people understand, when you say, hey, there's lack of liquidity, some people think, oh, well, maybe there's just not a market for it, because obviously a stock market, you have market makers and you can say, hey, there's always going to be a buyer for Apple stock. But with some of these private offerings, they can be restricted in the offering document, correct? Meaning that if you invest in this particular investment, there may be a covenant saying, hey, you cannot sell this to another individual per se, not just because there's not another market, but because the actual security itself in the offering that's being provided to you does have an inherent restriction. Could you touch on that a little bit?
Sure, absolutely. There is typically a non-assignability clause, or there's oftentimes you have to give the existing investors the first option to buy back your equity in the company. And so, or they won't allow you to do so at all, or they will want approval over who you would be selling it to. So it is very restrictive, even within itself. You may have heard of a lot of what's called secondary offerings, where privately held companies that are going to be having an exit and an IPO coming down the line, some of the original employees, some of the original investors may want to, in a sense, cash out and diversify their risk on go forward and sell their shares to someone. There's a lot of restrictions on how they can do it and what they can do. Typically, they have to give the right of first refusal to the existing shareholders, and then they have to get approval from the board in order to sell it to others. But that's become a really popular way of people sort of diversifying their risk in that situation. So yes, absolutely. It's not just that that it is illiquid and that you don't have a public offering. It's also illiquid in being able to just sell it to another private individual.
Yeah, that's a great point. I get a lot of questions on that. I would say from the people that maybe haven't done it before. Obviously, if you've done this, I hope you're reading offering documents to be an informed investor. But it's just good to know, especially if you're maybe new to this, is that, just because something, someone says, hey, it's illiquid. Oh, well, most people think, oh, well, it's just hard to sell. There might actually be a restriction on you actually selling this. So having a realistic time horizon on just how long you might have to hold some of these kind of things to see an exit, could certainly be something to consider, because it's not just the fact that, you need to be waiting for a liquidity event like an IPO, like she mentioned, which would be a company going public. And then in which case, it's, basically a cash alternative, so long as that there's market makers for it. Just something good to understand. So thanks for bringing that up, Kristen.
Absolutely. Absolutely. All right. So I think we'll move on. And as I mentioned before, a lot of these private offerings require the investor to be accredited. And so what does that mean? So you can qualify for being accredited from several different ways. One is if you've earned income that has exceeded $200,000 as an individual. It just went, okay, $200,000 as an individual, or $300,000 together with a spouse or a spousal equivalent the prior 2 years, and that you reasonably expect the same for the current year. So again, $200,000 if you're an individual, or $300,000 with a spouse. Or another way to qualify is if you have a net worth over $1 million, either alone or together with a spouse or spousal equivalent, excluding the value of your primary residence. So your primary home or condo cannot be counted under that $1 million net worth. Or if you have a Series 7, 65, or 82 license with FINRA, then you also would qualify as an accredited investor. And as an accredited investor, it allows you to then invest in most of the Reg D offerings.
That's a great point. And just before we kind of get past that, one thing I have much more often been asked is saying, hey, I do qualify as an accredited investor, but let's say I only have $100,000 in an IRA. Your accreditation is on your personal assets and income, which would then extend to other accounts that you hold. So let's say you have a $100,000 IRA and an offering is a $50,000 minimum. Your accreditation extends to you being able to use your IRA for that offering, correct?
Yes.
Great. Awesome.
So again, I'll just try to go quickly since I did sort of describe this earlier. So under Reg D, there's the rule 506B. And again, it only allows either the issuer, meaning the company that's raising the money, or the broker dealer that's licensed with FINRA, that's helping the companies raise the capital, which is what we do at Justly. We have to go to known investors. So we can't put it up on the internet. We can't put an ad out in the newspaper, or I guess on different types of digital publications these days. And so we have to go to known investors. It's privately held companies, as we talked about before. There's no limit on how much the offering size, meaning how much they're raising. And it's limited to only 35 non-accredited investors. Although I see most 506B really just limit it to accredited investors, but you are allowed to allow 35 non-accredited investors. Typically, I'll see that where it's someone that's a strategic that can help the company grow, that may come in. The company may allow them to come in as a non-accredited. There is a private placement memo is usually used, but not always. It could be a deck. You've probably seen a number of sort of marketing decks that explain what the company is with some of the disclosures. But oftentimes you'll see a very formal private placement memorandum as well. Accredited investors can also self-certify. So basically they can show how and why they're accredited through showing their accounts, their tax returns, etc. And then Rule 506C, there's no limitations to the solicitation. You can market it on the internet, through your LinkedIn, through group presentations, etc. There's no limit on the offering size, but only accredited investors can invest in 506C. The issuer has to take reasonable steps to verify that the investor is accredited, and there's a number of different ways to take those reasonable steps. And then disclosures, it's driven by market demands and liability concerns. But typically, most Reg D 506C issuers will do a similar disclosure to what they do in a 506B.
Before we get to that, we did have a question on eligibility. Fred asked, "I'm interested in an investment, and I'm told I need to be accredited as defined as 2.2 million of net worth. Why would that be different?" I really don't have an answer to that. That's kind of a strange, arbitrary number. You got any purchase on that, Kristen?
You know, I don't. With regard to accredited, there are different rules for different investments that over a certain amount that actually require someone to be either a sophisticated investor, which has different rules, or there's another sort of rule that's sort of more of an institutional investor. So I'm not sure where 2.5 million comes in. Happy to, again, if you want to email me, kuliga@investjustly.com. I'm happy to look into that and try to get you more of an answer. And you know, I think I would ask, is it a Reg D 506C or a Reg D 506B offering, or is it some other type of offering? Because I've never heard of really just, you know, to be accredited to have a net worth of 2.5 million. It may just be that particular issuer, or if they have a broker dealer that they're working with is requiring that for some reason. I'm not sure.
Yeah, I completely echo that. With all the offering documents I've seen over the years, I've never seen something defined outside of those parameters to that extent either. So I'd recommend Fred reach out to Kristen. She can take a little bit more look in that because that's weird from both of our friends, it seems like.
Yeah, and it may be based upon other existing investments that he has. So, but happy to definitely look into that. Great. And the crowdfunding, which is CF, Reg CF, it's a fairly new format that the SEC and FINRA has allowed under the Jobs Act a few years ago. And us at Justly, investjustly.com, we have a crowdfunding portal that is up, which allows companies to raise capital up to $5 million. And there's no restriction on accreditation. And oftentimes, there's investment that's as low as $100. And so, in particular, offering, you can have 1,000 investors that come in under that crowdfunding opportunity, and allows really to diversify your risk without having to put a lot of money in. And it also allows the company that's raising to be able to not only raise the capital, but also market themselves to you know, a big group of people that if they invest $100, $200, $500, are then going to be a supporter of that particular company. If it's a consumer product company and it's you put in the $200, you know, I know for myself, I would want to support that company. And so not only is it an opportunity for companies to raise the capital, but it's also for marketing. And what I wanted to do also is this is a sort of, I think, a perfect place to really talk about at Justly. You know, we are very focused on the ESG space. So what ESG means is environmental, social, or governance. And, you know, we like to look at that as really it has a societal impact. So whether that is a renewable energy company or woman-owned or minority-owned company or consumer products that give back to particular nonprofits, we really focus on that area and work with companies to help them raise capital in those areas. And we work in Reg D that we just talked about, Reg B, Reg 506B, 506C, Reg CF, and crowdfunding. We have an actual online platform that people can go on and look at the website and learn more about the company. And so what we really, and why I moved my broker-dealer licenses was I really love the fact that at Justly, we work with these companies to really help not only raise capital, but also do it in a way that's good and beneficial for society. And if it's a company that isn't in the ESG space, we actually donate 20% of our fee to nonprofits. One in particular is called As You Sow, and it's companies that it's an organization that really help sort of be a watchdog for companies to do the right thing by their shareholders. So whether that's for good for the climate or just looking at what they're doing and not trying to railroad investors, et cetera. So that's what we do at Justly. And, I'm really excited to be part of this organization to really help not only, make everybody money, from investors to, the companies that we work with, but also do good. And so that's something that's been really important to me throughout my career. And now I have the opportunity to do it with Justly.
That's a really cool point that you bring up. Sorry to interrupt for a second. If for people that maybe haven't necessarily heard of ESG, I know, again, personally, I hadn't until I got plugged in with Justly. But a lot of people, kind of as a catch-all, kind of outside of this, ESG is a definitely parameters-based thing when it comes to looking at, identifying a company and how they fit into an ESG profile. But people might be more familiar with the term like impact investing, correct? Which kind of bleeds into this, but this is a much more defined area to kind of write the criteria and actually have a kind of a defined metric for these types of investments for these companies that either give back or have some type of social and governance component to it, correct?
Absolutely, absolutely. I think a lot of people have heard of social impact, and that's what we're doing. There's now, ESG is now the new term for social impact.
Right.
And we also work with a company called Proof of Impact, which rates organizations with regard to how much impact they actually have. And then we also are working with a group called B Labs, which actually gives a certification that a company has to go through a lot of steps to actually show their rating, that they are certified as ESG. And so we really, look at that in addition to companies that have, good growth potential as well. Has to be a big part of it, obviously.
Having that is great, but the ultimate, if you're not making money and everything's just a bust, it's not going to entice people to invest. But the cool part about this is that you can take your dollars and cents and make an impact and still make a profit, which I thought was probably the coolest thing when I initially talked to Paul with Justly on that podcast. I think it was about 3 or 4, actually, I think it was last week we put that one out. Just about the fact that you can make a profit and feel good about the profit you're making, and that profit can help drive positive social impact in the world. It's not just saying, hey, I made money at the expense of everything else. I clear cut the rainforest to make $100. You can make $100 and be feel good about the money that you're making. So that's really awesome, and you're going to be getting into more of that in here in a minute, I'm sure.
Yeah, absolutely, absolutely. And I'll talk a little bit more about those companies for sure. But it's interesting how I met Justly. I sat next to a woman at Aruna who's the head of marketing at a family office conference, and I realized that they actually benefit the Doug Flutie Foundation for Autism as well, and they support that and children with autism. And that was one of the first charities that I actually had started with Doug Flutie, and we created a social impact product called Flutie Flakes, where half of the profits went to the foundation to help children with autism. So there's a way, and what we're doing is, everybody wins, and we're doing things that are good for the environment, good for society, but also make everybody money. Or hope to make everybody money. So it's a win-win for everyone.
Yeah.
I'm going to just skip through, go quickly what a Reg A Tier 2 and a Reg A Tier 3 is. It's basically a public offering that doesn't have to go through the formal IPO process. And so it allows you to raise on a Tier 2, 75 million, on a Tier 1, 20 million. It's something that it's been out there in the market, but not a lot of companies have used it, but it's becoming a little bit more popular. We have one Reg A, I believe, offering on our platform, but it's just something that I think to really take a look at and see if that's something that is it's an opportunity where, because it will be going public, there may be more liquidity out there for the investor. And we obviously talked a little bit about what is ESG investing and what is Invest Justly. And just to reiterate, ESG stands for environmental, social, and corporate governance. And to us, that means a lot of things. It could be a pharma company that is coming up with a new cancer drug. It could be a renewable energy company in the electric vehicle space, in solar, et cetera. It could be a biotech company that's creating the next device for heart stents, etc. It could be a woman-owned business. It could be a consumer products business that has some tie-in to a nonprofit or some social cause, similar to something like Bombas Socks or Paul Newman's own, if you were investing in them at the early stage. So consumer products that has some type of social benefit, or is a woman-owned or minority-owned business, a fintech company that brings opportunities to inner city kids to learn about finance, a sports technology company that works on mental health for professional athletes. That's an app. I'm just kind of throwing out a lot of different ideas, but I think a lot of people, in the alternative investing space think of real estate, as you talked about, but there are all these opportunities to invest in companies in the ESG space, and at Justly, that's what we do, is work with these companies and give investors the opportunity to invest into these really incredible companies that really traditionally it was meant for, not meant, but venture capital or private equity firms or those associated with them were really the only ones that had access to these deals. And so what we're doing with our crowdfunding platform, the CF platform, is to really democratize the opportunity for anyone and everyone to own that next, piece of Uber. If you invested $100 into Uber 10 years ago or 15 years ago when they were at the early stage, that would be worth a lot of money right now. And so that's what we're trying to do, is really create an opportunity for private issuers to raise money from like-minded people that want to not only make money, but do good as well. That is sort of, our presentation. I believe hopefully I hit upon a lot of the areas that we were supposed to, and would love any questions.
Yeah, no, absolutely. I think that was a very good overview of kind of, what this is. Just to kind of maybe dig in, so we do have a few more minutes left. When it comes to ESG from the perspective of, what Justly does, do you kind of have like just a broad net approach, or are there certain markets that right now you're focusing on? Like, I mean, you mentioned women-owned businesses and minority, governance on boards, kind of two easy ones to pick out. But is there kind of certain market segments that you're looking at right now, or are you just trying to take it all in and just identify those ESGs with growth potential for people? Or are there particular like ESG segments, like you mentioned, like women-owned businesses, that are of particular interest right now for whatever reason? If you can maybe touch on that, I think that might be interesting.
Sure, absolutely. So Justly is owned by a company called Ideanomics, that is a publicly traded company that focuses on renewable energy, electric vehicles, et cetera. So a lot of our companies and issuers that we work with are focused on the renewable energy space. However, as I have been here for a whole 2 weeks, we are looking at a lot of different sectors. We have some, we're looking at the pharma space, we're looking at the fintech space. Woman-owned is something that obviously for me, on my sports side, I had my own business. I sold that a few years ago, and so supporting other women is something that I have a passion for, and I know the company is looking for women and minority-owned businesses across a number of sectors. Consumer products is another that we are looking at as well. It's not really, in one particular area, so which is great because there are lots of options that we can focus on in the ESG space, or if it's not in the ESG space, then, we donate a portion of our profits to these nonprofits. So, it allows us to really have diversify what companies we're working with. And so, I guess going back, I think that the pharma, renewable energy, woman owned are big focuses. But, again, our platform allows us to work with companies that are doing a lot of amazing things across the spectrum in the ESG space.
Yeah, awesome. And specific to that, are there any types of like metrics that you could look at saying, hey, it's always good to feel good and do good with your investing, but is there a particular maybe kind of metric to say, hey, ESG, qualifying companies are ones that have a focus on this type of, just say operations for lack of a better term, of how they potentially can perform better than companies that maybe don't focus on it, or what the inherent benefit besides just what the good things that they are doing in social impact areas like that. Is there kind of a certain metric saying, hey, here's why this makes sense from a feel good perspective, but hey, here's why this is in general kind of a good thing for making profit?
Sure, sure. We have a whole due diligence team at Justly that reviews all of the documents, does their research, looks at what the comps are out there. We do, meetings upon meetings of meeting the founders, talking to them, really analyzing their financials, all of the things that you would hopefully expect as you're looking, whether you're going through a broker dealer or you're going direct. We do that at Justly, is we do the due diligence before we would even represent a company. With regard to the impact, we work with a company called Proof of Impact, and they rate the companies as being in the ESG space. And so the higher the rating, the more impact that they have with regard to in whether it's environment, whether it's societal or governance. And so we work with them from that standpoint. We have our due diligence team that is that is experienced, that works in that space, that really understands looking again at the financials, et cetera. And then we also, again, from the ESG space, we work with B Labs, and that's a longer period of time where a company can actually get certified. Similar to, I would say, well, I think it's a Proof of Impact is similar to Charity Navigator. I don't know if anyone is familiar with that, where they rate charities based upon how efficient they are and how much they're giving back. And Proof of Impact is based upon, how much impact they have under the ESG space, where B Labs is an actual certification that a company has to go through, all of these different procedures before they would get certified as an ESG company. And then again, going back to from a profitability standpoint and the opportunity to ultimately make money, we as an organization don't necessarily want to be working with every single company that just is in the ESG space. We need to make sure that we do our best of due diligence to believe that they would, in fact, make a profit, have a successful exit. Our investors, will do well. But, you can't always guarantee that. There's no guarantee. And so, we always say that up front. As we talked about, there are risks associated, et cetera.
Yeah, trust but verify is the thing that I always like to make sure I hammer home to my clients. We have a question that popped up, so thank you for asking these questions. What about Verivest, who certifies accredited? I may have my name spelled incorrectly, but is that like a some type of like accreditation provider, like a third-party provider that you might be familiar with, Kristen?
Yes, we do have, there are a couple of different groups that will actually do the certification of your accreditation. And so we do work with some of those. It depends again upon whether it's a 506B or a 506C, whether we have to go through a third party or we need certain documents, and we do work with them. We work with another one as well. And because I'm new, I'm not sure the other one that we use to show that someone is accredited. But again, if it's a C where everybody has to be accredited and we have to do more due diligence to prove that they're accredited, we use third parties. If it is a 506B, I need to check to see if they require us to go through the third party or if we can actually do it ourselves through the investor submitting certain documents.
Yeah, and your director of marketing posed a question over here of how do you know someone is really ESG based? I think we kind of covered that with the kind of verification processes and the other third parties that y'all have used to that point as well. So I think we kind of covered that question. But with that said, I kind of think that we have a good landing point here. From what I really like to hammer home is that this is really kind of a new way of thinking about, making money and you can feel good about the profits that you make if you look to invest in these types of sectors. Not to say that anyone should say, oh, I'm only going to only invest in ESG. I mean, it's great that this is out there as another tool for investors. But again, it's one of those things you really need to do your research, because just like anything, if you're looking to invest in the private space, these investments can be highly illiquid, carry a significantly higher degree of risk, but they can also be very profitable. As Kristen said, if you were an early investor, and take any big tech startup, Uber, Facebook, Twitter, just kind of shows that if you could get in early to some of these investments, those can pay off, huge dividends down the road. But again, doing your due diligence and understanding what you're investing in, the markets that they're investing in, is hugely important. So with that said, again, I want to thank Kristen very much for being on there. Kristen, how can they get in touch with Justly if they'd like to learn some more about what y'all have going on, look at your crowdfunding, and potentially engage for more education and investment opportunities?
Sure, sure. And I just wanted to add to that about your due diligence. I always, we always find that, if it's a space that we're not as familiar with, ask the people that you can network with that are in that space. What their thoughts are, looking at the documents, et cetera. And so it is important to also, as you said, do your own due diligence as well. But yes, absolutely. Anyone feel welcome to email me. It's Kuliga at investjustly.com, or come to our website. It's investjustly.com. And you can see some of the different Reg C offerings that we have, CF offerings, also some of our private offerings that are under the 506C. And if you're interested in some of our 506B offerings, I can get to know you and then be able to share those as well.
Fantastic. Well, I really appreciate your time today. I know we had a couple little things, and we both kind of stepped in and it's a little bit of the last hour to make this work, but you were great. Thank you very much for providing some awesome information for the people on this call today. We really appreciate it. Again, if you have any questions, that's how you can reach out to Kristen. If you have any questions for the self-directed IRA or qualified retirement plan side of things, my contact information is up here now. With that said, I'll let everyone get back to their day. And if you would like to grab the slides, they are right there on the handout, or you can email me and I can email you a copy of them as well. So again, Kristen, thank you very much for being a part of our education today. And with that said, I'll let everyone get back to it.
Thanks so much for having me. Appreciate it.
Our pleasure. Thank you.